Hello, hi. Today I've come with a new video, financial accounting. My main objective is to teach financial accounting without using debit and credit. I still remember the memory is still fresh when we were in class 11 12 and we are trying to understand accounting, mugging up golden rule. It used to be too much for us. So it might be the same for the students who are studying accounting in 11 and 12. But I can see when I am teaching undergrad students, when I'm teaching postgrad students, even the students still are facing the problems of having the basic understanding of financial accounting. We initially start thinking about debit and credit, but today in this video I'll try to teach financial accounting without using debit and credit. So I'll be making series of video where I'll be making other videos also relating to accounting, and I'll try to make a very simple video. So I believe that in order to learn something, one need to have a module, one need to have a strategy, one need to know how to understand something or some concept very easily. And this video will be helpful not only to 11 12 commerce student or BCom BBA or MBA students, but this will be helpful for the non-professionals, non-accounting professionals also, those who want to understand accounting for any reason. So let us move on to the flow. Let us move on to the next slide. So David, understanding accounting with the help of debit and credit, I feel, is one of the blunders. I'm not telling that one need to understand one need not understand debit and credit. We need to understand debit and credit, but first there is something which as a student of commerce need to understand. So about debit and credit, the more I think, the more confused I get. There is golden rule, mugging up golden rule, trying to segregate debit and credit. This will only confuse student or anyone who's trying to understand accounting. So today I will try to understand accounting. I will try. Please comment whether I'm successful or not. I'll try to explain accounting in a very simple language. Let us move on to another slide. I'll start with the definition of accounting. There are various definitions of accounting, but I've taken a small part of the definition of accounting. Accounting is the process. We need to understand accounting is a process of recording financial transactions pertaining to a business. So accounting is a process relating to transaction of business. But yeah, accounting, some of you might be thinking that accounting is not only the process of recording, it is the process of summarizing also, analyzing also, reporting also, or presenting it also. But in order to make the video short, I'll be focusing only on the accounting process as a from the recording point of view. But we need to understand that accounting is a process relating to business. So before understanding accounting process, we need to understand business process. If you are able to understand business process, it will be very easy for us to understand the accounting process. So let us see how is it possible. So first we need to understand what is business, what is the business process, and then we will need to think from that angle. Then it will be very easy for us to understand accounting. You might be thinking accounting is related to business. So accounting is also known as a language of business. So we are learning the language of business, but we do not know what is business is. So first let us see, before learning accounting, let us see business. Any business starts with an idea. So this guy in this picture has an idea to make a shoe. The idea can be anything. It can be relating to making a shoe, making a sugar, making clothes, making a car. It can be any, making mobile phones, giving services. So this guy in this picture have an idea to make a shoe. Why you want to make a shoe? Why any businessman want to do business? Obvious, it's very obvious, to sell the product and earn profit. But for that, if you see, there is a journey from idea to process. There's an idea and the process. Manufacturing shoe is a process to convert idea into product and earn profit. So in order to achieve the target of earning profit, everyone knows, even class 5, 6, 7 students will understand one need cash. And this cash can be own cash. Suppose I'll give you an example. I want to start a business. I want to make a shoe and I want to sell it. For that, I need my own money. If I don't have my own money, what I will do is I will take other people's money. And when the business is using cash to start a business, that cash is known as capital. And in accounting, in finance, this cash is divided into two types. One is equity capital, another is debt capital. When the promoter or the owner is using own money, that is known as equity capital. And when the business or the owner or the promoter is using other people's money, like selling of bonds or through loans, bank loans, that is known as debt. So now you need to understand, in order to start a business, one need to have an idea. In order to convert that idea into a product, there's a process of manufacturing shoe, for example. In order to make that process happen, cash is required. That cash can be own cash or other people's cash. And this cash is known as capital. There are two types of capital, equity capital and debt capital. Now, why do we need capital? Why businessmen need capital? Let us focus on that point. Why do you need capital to start a business? So your main objective in this slide is to make shoe. Say I want to make a shoe and want to sell it. So one need to understand, whenever we think of making a shoe, the first thing that comes in our mind is raw material. Say for example, I want to open a restaurant, I want to sell momo. First thing, I'll think about momo, and then I'll think about the materials required to make momos. Like if I want to sell vegetable momo, whether I want to make use cabbage, how much onion, that things will come automatically in our mind. So that is no different for the big business conglomerates also. Like many shoe making companies like Adidas, Fila, Jara, they will think in the same process. They want to make a shoe and the raw materials are required. So these are all the raw materials which are required to make a shoe. You can just see these are the various raw materials. These are some of the important raw materials to make a shoe. So you all know that no one will get free of cost all these raw materials. A businessman need to pay. So they need to pay, that is why they need capital. But once they have a raw material, this raw material will not automatically get converted into shoe. This raw material has to be processed. And this raw materials are processed in a machine. That is why a businessman need to buy machinery also after the raw material. That is why businessman needs capital to buy raw material. Businessman needs capital to purchase machinery. After these raw materials are processed in the machinery, ultimately a shoe is made. This is still in a thought process. Still the businessman need to think of other ways also. Say for example, this is an area, huge space is there, a huge tract of land is there, and you only have a machinery and a raw material. You cannot keep this machinery in the middle of the ground and leave it just like that. You need to think about something else also. There's a land, there's a machinery, not enough. You need to keep this machinery inside the building, inside a factory. That is why in a business, a building is also required. So after raw material, three things are very much essential if you want to manufacture a shoe: land, machinery and building. So land, machinery and building is known as fixed asset or asset. You know what is the meaning of asset. Asset means any item which will bring money inside the pocket. So raw material is also asset, because using that raw material you will make a shoe When you sell the shoe, that money will come inside your pocket. So anything which brings money in the pocket is known as asset. But there are two types of asset. One is fixed asset, another is current asset. So land, building, machinery is fixed asset because the businessman is not going to sell this land, building, machinery. They're going to use this asset in order to make a shoe. But the businessman is going to sell the shoes frequently, again and again and again. So that is why any item which is related with in making of the shoe, like raw material or a cash is also required to make a shoe, that item is known as current asset. I'll not confuse you further because in the coming slide also I'll explain it to you. What is it? So in order to buy this fixed asset, business need capital. So in order to buy current asset, in order to buy fixed asset, business need capital. So let us see on the left hand side, I have put the machinery, land, building. Now you know this is called as fixed asset. I'm just categorizing it. I'll keep fixed asset on the one side. I'll keep assets on the one side, both the fixed asset and the current asset. So these are all the items, these are all the raw materials to make a shoe. And as I've told you, these are known as current asset. But this fixed asset and current asset is not going to come free of cost. In order to buy fixed assets and current asset, a business need to have a capital. As I told you, there are two types of capital, equity capital and debt capital. So one business need to have the capital. And why they need to have a capital is to buy fixed asset like land, building, machinery. So this with this capital, they will keep some cash also. Because as I told you, the business will have to buy raw material again and again to make a shoe, and there is a turnover, there is a cycle. They will buy raw material, they will make shoe, they will sell it, get money. They'll buy raw material, they'll make shoe, they will sell the shoe, they will get money. With that money again they will buy raw material. This is a cycle. This is known as operating cycle in the business. So a certain amount of money is also required, and as I told you, anything that can be converted easily in a money is known as current asset. So obviously cash is also a current asset. And this equity capital and debt capital is known as fixed liabilities. Why liabilities? Because in accounting, even if I'm starting a business, I'm starting a business, I'm just giving an example. I'm starting a business, I'm using my own capital, I'm investing money in the business. For the business, that money will be a liability, because from accounting point of view, that business is a separate entity. That business is considered as a separate person. Say for example, I'm starting a business XYZ company limited. So accounts will treat XYZ company limited as a different person. So when I'm investing money in the business, it's like I'm giving money to that business, even though I'm the promoter, I'm the owner. So for business, capital is liability. And I'll tell you, this capital is not going to come free of cost. In debt capital, business will have to pay interest like loan. In equity capital, they'll have to pay part of the profit. And as I told you, the main objective of the business is to sell shoe. We should not forget that. So when business is selling the shoe, as I told you, what they will do is they will buy raw material, they will sell the shoe. When they're buying raw material, money is going out of the pocket. When they're selling the shoe, money is coming inside the pocket. So again, money is going outside the pocket to buy the raw material. When they sell the finished good, money is coming inside the pocket. So when money is going outside the pocket, out of the pocket, that is known as expenses. When money is coming in the pocket, that is known as income. When you were in class 5, 6, 7, 8 or 9, you have studied a formula, famous formula in arithmetic, SP minus CP is equal to profit. Selling price minus cost price is equal to profit. So the transaction relating to the buying and selling. The transaction relating to the expenses and the income is recorded in an account called trading and profit and loss account. Trading and profit and loss account. So in the coming video, I'll make a simple video relating to what is trading and profit and loss account. So the main objective of trading and profit and loss account is to make net profit. So this net profit is ultimately added with the capital. So you must be thinking, why this net profit is added with the capital? I'll give an example. Suppose I have 1 lakh. I have started a business. Any business. I invested 1 lakh. I earned 50,000. What I will say? I will say, I had invested 1 lakh. Now I have earned 50,000. So now I have total 1 lakh 50,000. I'll say now I have a capital of 1 lakh 50,000. Unknowingly, I'm adding 50,000 with 1 lakh. Everybody will do this naturally. So in accounting also, even big conglomerates, after paying for everything, whatever net profit is left will be added with the capital. And I'll come with the other video. What is capital? I'll discuss everything about capital. But today my objective is just to relate accounting with the business process. How to think first, how we need to think before understanding debit and credit. And if you see, there is a cycle. Businessman will invest capital, will buy fixed asset, will buy machinery, will buy raw material, will make the shoe or any product, will sell it, will earn profit, will add that profit to the capital, capital will grow. Again, they will buy raw material, they will sell the shoe, they will earn again more profit, net profit again add with the capital. So over a period of time, they will have so much capital, and over a period of time, they'll have so much goodwill in the market, brand, we call it brand. So everybody wants to buy Adidas shoe or Fila shoe, a Zara, a Timberland. So these are brands. So over a period of time, this business will create a brand and they would like to grow. Say for example, the businessman is selling shoe in Gantok or in Darjeeling. Now they want to sell it, in Siliguri also. Now they have capital also, they want to expand it. So again, using that capital, they will invest in fixed asset, they will buy land in Siliguri, they'll buy factory, they'll manufacture the shoe. This is a process, a cycle, it goes on and on and on and on. But sometimes what happens is that in a business, this, due to stiff competition, because so many companies are selling the shoes, it happens that some client won't give money when they're buying, shoes. There's a concept of EMI also. When you open Flipkart, Amazon, you understand what is EMI, or buying shoe with a credit card. So business will not get the cash, but there's a demand in the shoe, demand for the shoe in the market. So in that case, what will happen is the company will have to make a shoe, but they do not have raw material, and they'll take help from a guy in the market. You can see in the picture, the left hand side, wearing a hat. He will tell you that, okay, I'll supply you raw material, you can pay me later on. But there's an obligation to pay. Money will go out from the pocket in the later days. That is why this creditor is also a liability. And as I told you, liability means any item which takes money out from the pocket. And if you see on the left hand side, there are fixed liability and current liability. Fixed liability means it's a liability which can be paid after 5 years, 1 year, 10 years, 20 years. But if you see current liability, say for example, you have taken help from the creditor. Creditor means a person who supplies raw material or any material required to make a shoe or any commodity or a product. But they will not wait for a very long period of time. So as a businessman buys product in a credit, this creditor will come next month, knock on the door and say, okay, give me the money. So that is why this creditor is known as current liability. And there is a concept of debtor also. When the customer is not giving money, that person is known as debtor, but we will get money from the debtor. That is why that debtor will come under current asset. There are other items also in current liabilities, but today my objective is to help explain the process of business. Before understanding accounting, you need to understand this process, this cycle, the relationship between the capital, the fixed asset, the asset, current liability. This is what happens in the business. And ultimately, you know that this two side of assets and liabilities is known as balance sheet. This balance sheet always balances. And this concept is so much powerful. Using this concept, in the coming days, I'll be teaching you financial management also. If you can see on the left hand side, capital. So financial management is all understanding about capital, finances. Whole 200 marks paper you have in MBA or MCOM. And I recently made a video on the various forms of business. So if one person is giving money and doing the business, that is known as sole proprietor. If you can see on the left hand side, owner capital only. If 2% or more than 2% is giving capital, that is known as partnership business. In company forms of business, this equity capital is divided into 100,000 lakh owners or owners. So capital market is a different chapter, stock market is a different chapter. I'll be teaching you using this equation only. So not only that, other subjects like business organization, marketing, even law, even economics, even sociology also can be taught using this concept. But you must be thinking, how is it possible? I'll make it possible. I'll try to explain it in the coming videos. So I'll not, go on explaining the same concept again and again. I hope you understood it. If you did not understood again, you're not able to understand it, you can rewind it and check the video again. So if I had directly shown you the balance sheet of a company, you would have never understood it. I mean, even the commerce students also have seen. Forget about the non-accounting, persons. So even if you see the balance sheet of a company, these things are only mentioned, but the only difference is that words will be there and the numbers will be there. So in the coming video, I'll explain you in a very simple manner what is trading account, what is profit and loss account. And once your concept is clear relating to the balance sheet, trading account and profit and loss account, I will teach you what is debit and credit and how to make a journal entry. And in the future, I'll explain you how to analyze balance sheet, how to analyze profit and loss account. I myself, I have been in stock market for 8 to 10 years. I've been trying to learn. I'm still a student trying to understand stock market, where I normally analyze balance sheet, profit and loss account to understand about companies. And I've been teaching accounting for more than 7-8 years in various universities. So I hope you're able to understand it. And in the coming video, I'll make it more simpler for you. So please, my only request is to like, and even if you don't like, please dislike and write in the comment box why you didn't like this video. I'll change myself. I'll try to improve myself. I'll be very happy. And yeah, please share it also, because this video is going to be helpful for the 11-12 students also, and even for the undergraduate students also, MBA, become MCOM students also, and non-accounting professionals also. So this video should reach everyone who want to understand accounting in a simplest manner. So please subscribe the channel so that you'll get the notification. And this is my channel name, Be Knowledge Online. And thank you for watching this video. See you soon. Please do not forget to wash hands. Take care.